Herzlich willkommen bei der Edelstoff Media. Ich spreche heute mit François Collet, einer der Portfolio-Manager des DNCA Invest Alpha Bond. Mr. Collet, the bonds are back in town. You have been managing the DNCA Invest Alpha Bond for 12 years. Has bond management become easier after the interest rate turnaround?
I think in a way, yes, it's been easier in that sense that it's always easier to get positive returns when you get a decent level of carry. So seeing short-term rates at 4% now is giving you some room before being negative. But on another way, it's maybe more difficult to outperform markets in that sense that there is more volatility in the market. Markets are moving quicker than in the past, and this makes much more difficult to overperform.
You have achieved positive returns regardless of whether the markets have fallen or risen. Please explain your strategy and what made a difference in the last 12 years.
I think the main difference is our capacity to be flexible. We have the capacity to be either long or short in alpha bonds. And the second thing which is explaining the difference is that you'll see a lot of absolute return, unconstrained funds, but we especially don't target a certain level of income. A lot of funds are targeting a level of income, and as yields went down and down, they had to have more and more risk in order to compensate for the sharp decrease in income. And we didn't do that. We tried to move the portfolio in order to be able to achieve positive return, whether rates are up or down, spreads up or down as well.
Can you elaborate on how your team uses the risk-adjusted term premium to assess the relationship between expected return and risk?
Yes, so we are a volatility-constrained portfolio team. So what we need to do is to deliver with a volatility maximum of 5%. And we rely on this very interesting tool, which is assessing the risk-reward of each fixed income asset class. What we try to do is to look at a kind of Sharpe ratio on the duration risk premium, the credit risk premium, inflation risk premium, or the fixed income risk, the forex risk premium. And this model is helping us to look at different sub-asset classes to figure out where the best risk-return profile is. We have a low risk budget to allocate. We want to be invested in the part of the market where the risk-reward is the best.
Given the budget deficits in major economies, how do you plan to integrate the increased supply of government bonds into your investment strategy?
The idea here is that we should see much more pressure in terms of issuance, and that should lead toward rebuilding of the term premium. It's still not the case. Yield curve are inverted for most of them, but what we expect is to see a re-steepening of yield curve. So we have long exposure on short end of the curve versus short exposures on long end of the curve.
Are high yield bonds or emerging market bonds more interesting now?
I think that there is a very interesting investment opportunity for emerging markets. We are seeing a kind of long-term rating convergence between EM economies and DM economies. EM economies have been much more conservative in the conduct of their policy mix over the past decade, and this should favor rating upgrades for most EM economies, while we are expecting some downgrades for a lot of developed market economies. When it comes to the high yield market, we are much more conservative today. We think that credit spreads have tightened quite a lot last year, and that it's not just the time anymore to be long high yield.
In your opinion, what is the best bond allocation for a diversified portfolio in 2024?
I still think that makes sense to be defensive in the fixed income space. I know that a lot of investors are thinking that bond market is a very interesting opportunity. We think it's more important to be cautious, so to stick to short end of the curve. First of all, to continue to invest in inflation-linked bonds. Real rates have risen quite a lot, and therefore they offer a very interesting risk-return profile. We tend to allocate a part of our assets in emerging markets, and to diversify our risk with currencies and with steepening positions.
What specific challenges and opportunities do you see for the bond market?
The main challenge of the bond markets is the fact that a lot of cuts are already priced by the market. So the market is currently pricing 5 cuts from the ECB in 2024. That means that if the ECB doesn't deliver that 5 cuts, it will be very difficult for the market to overperform money market rates. So that's the main challenge for fixed income market. While opportunities, well, we've seen quite an interesting rise of rates, which should favor the bond markets. We have a decent level of yield, which is incorporated in all markets, and therefore we're not going to repeat the very ugly performance of 2022 in the coming year.
Thank you for the insights, Mr. Collet. Danke Ihnen fürs Zusehen und bis zum nächsten Mal.